Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, July 18th, 2023. Markets are now closed. What I'm going to do in this one is just keep it limited, so it won't be a super long video. We'll keep it limited to the equity markets, kind of analyze them. I want to look at a few breadth indicators. I've talked quite a bit about breadth this year. I know others have. That's been a unique market in that aspect, so I'll get to that. We'll look at some indicators, things to watch. And then at the end of the video, I'll try to answer a few questions from the comment section today. But let me just say this, that on the non-equity things, just real quick, wheat's still looking good, still above the back test of that trend line. It's still 60-minute divergences, everything else there. Natural gas still also looking, potential bottom in place for natural gas. And I'm talking swing or trend trades, not just short-term trades. I'm going to again, try to clearly differentiate what I mean by short-term active trades. I use a lot of terminology. I wear a lot of hats. I'll day trade. I do thousands, literally thousands of trades a year, probably over 1,000 on just NQ alone, something like that, one security. But and those are a lot of those in and out. Sometimes I'm in and out a dozen times in a single day when the volatility is there in NQ. So I'm going to speak to that. Because I know there's a lot of confusion between what is a swing trade, a trend trade, are we long the, or short the indexes now, things like that. All right. And then gold, silver, I gave you an update this morning, so no update there. Gold ran into that resistance price target. It's stalled out there all day since, so that's a reaction for you. Okay, let's start out here with the NASDAQ 100 futures, and I'm going to say something I've said at least a dozen times over the last 2 months now, or a month and a half, whatever it was. Until and unless we break this trend line, we're not going to get a big correction. We have an uptrend line, a very well-defined uptrend line on the NASDAQ 100 futures, which we're looking at here. It is, again, very well-defined. That is by the number of reactions. Most recently, we hit it there. We never took it out. We put in a divergent low. We rallied. So as far as swing positions, no, there's no swing or trend sell signals right now. But again, I get the questions put to me. So what I posted today is active trade setup with a current max target, and I did answer some of those questions just before this video in there. So if you look at where we're at, let me move that little DH divergent high. Calling for a zigzag. It's not, the zigzags are shown kind of where I guess on the shorter term charts. You're talking about a 4% pullback. Usually on a day trade, and that's the thing too. I also talked about it. Hey, it's earnings season. If you take a trade, you're gonna, sometimes, quite often, especially when the big companies report. We're talking, you're not going to see Lennar Homes blow away expectations or have a horrible miss and move the S&P 500, but you will see Apple, Microsoft, Alphabet, Amazon, Tesla, Nvidia, and Meta. They have the potential to move the market, and they often do. So now, this is what I'm referring to. We're in that peak earnings season. By this week and next, by the end of the month, all those big tech companies out of the way. Even the big giant financial institutions can hardly move the needle even when they rally because their weightings aren't that much. It's just simple mathematics, that big weighting in the big fangs. So, okay, what's the takeaway? Well, either, don't trade a tech-heavy index like the NASDAQ 100 if you're risk averse, or you can day trade in and out, get out of the way before those earnings report. You have the earnings calendar. There's a link to it on the site. Big tech typically reports after the bell. I think, what is it, Tesla tomorrow? And Tesla and Netflix, if I remember right. I'll have to recheck that. Or you can be a purist in the chart. Sometimes, you can just put a trade on if it looks like it's going to play out and have a trading plan. A trading plan, every single trade should have a trading plan. What are you buying or selling? In other words, shorting. Why are you buying or selling it? Going long or short? Where are you going to stop out if wrong, and where are you going to take your profits if right? Now, a trading plan can be modified as the trade goes. You may have multiple targets. You may have multiple entry points, which is going to call for a different stop. Somebody asked about that. Stops are going to be different for every trader based on their entry, what their target or targets is. I like to quite often take profits along the way on certain trades. And so it's all going to change. And, if you have a risk-reward ratio that you might like, Some traders want a high RR, like a 3-to-1, risk $1 to make three. Some might even want a 1-to-4. Typically, over in recent years, is my overall success rate. Not batting 1,000 recently. There's no, at least not on the indexes. But overall, as my success rates increase, I've found moving closer to a 2-to-1 RR, I do a lot better. Where I can almost, the markets have almost evolved to where the algos know where the logical stops are. They know where logical pullbacks to support. Like, for example, this. They know traders bought that pullback to the trend line in NQ. So they know there's entry points there, and they can calculate, and they can also see, they can buy the data to see where the stop clusters are. So one of my, things around placing stops is you kind of try to figure out where the masses have their stops, and then you want yours a little bit either on one side or the other. If you want to have a tight stop, you want to be before them, but usually you want to be outside that range by a little bit to allow that stop raid. And that's why I often talk about, if you can wait for a 60-minute candle close or even a daily close, depending on which time frame you're trading on a daily chart, meaning a daily close where that candle closes at 4 p.m., you'll avoid getting stopped out on a trade or jumping into it, entering a trade on a breakout that proves to be a whipsaw that briefly moves above a trend line or support or resistance level. And so those are many of the things you can do again, but that requires full-time trading. You need to be in front of the computer to do that. Okie doke. So this is it. Again, uptrend line. Unless that goes, we're not looking at anything deeper than, at this point, a pullback. However, these divergences are building. Somebody asked, hey, Randy, that trade you threw out today, which, did trigger an entry shortly before the close. I'll get to that one second. Is that a swing or a short-term trade? It is, as posted, a short-term trade. I gave you, let's step down to that 15-minute chart and talk about that. But it has the potential to either the same trade, but this one will probably be covered on that trend line, or one of two things. Let me just jump back to that. I know I'm all over the place, but I'm trying to talk trading strategies here. Let's just say one of these big fangs get whacked and it starts to suddenly knock the wind out of the sails of, the bulls and the momentum. And you see us heading down here. And you do believe, because again, this thing is getting bigger and bigger and bigger. And I see the snide comments about divergences. Oh, just negative divergences. I've always said, and you've heard me say it 1,000 times, 1,001 times. Divergences are not a sell signal. They're an indicator, they're a condition in the market and an indication that a trend change is likely. And it was those same divergences that bottomed this market back in October of 2021. And it was those same 60-minute divergence. That was on the daily. And then on the 60-minute chart, we had beautiful bullish falling wedges and the big fangs bottoming at support with bullish divergence, and that's the same criteria that got us long at that point. And again, all I can tell you is that they don't always play out, but much more often than not, they do play out for a trend reversal. And so where I'm going with this is, I know most can't even imagine it now with the strength in the market, but the one thing, I've been doing this a long time, and I've learned long ago, never underestimate just how quickly bullish or bearish sentiment can evaporate or change on a dime. So that's it. So we go down here, and the point is, if you're of a mindset that we are going to take this out and go quite a bit lower, and this is a bear market rally, I'll speak to that in just a second again, talking about the markets getting near new highs, then what you do is, as you approach that target, instead of booking profits there around that, 15, the trend line, 15,425, you set a stop and you let it run. Because sometimes, although the odds for reaction on the initial tag are pretty good, sometimes you'll just hit it and you'll pause there or even go right through it. I've seen that happen many times, where you just go down through a support level. So by doing that, by once you get close, by setting a stop, you're giving back a little bit of profit if you hit the level of, if QQQ happens, or NQ, I'm just using NQ here right now, happens to go down and bounce, and instead of booking profits right on or right above the trend line, a lot closer, maybe you give a little back, but it allows you to stay in the game. So that's up to you. Let's see how some of these fangs start to report. But I would say this, it's not far away. that's a single day move right there, 3%. One bad report, just like one good report could send us up another 3%. Actually, it's closer to 4. I had a 3.62 from where we're at right now, called 3.5%. But we could go on down through there. So that's how it looks there. Okay, back to that 15-minute chart. So this is, let me move that. Here's those, little trend lines, and I circled the, potential buying climaxes. When you all of a sudden have a near vertical spike, those tend to be faded, and even in an uptrend. So you can, as an active trader, the game of pullback trade 1, 2, 3%. That's usually what these run. Lately, they've been running about 1.5% as measuring these out there, 1 to 1.5%. Certainly worth your while if you're an active trader. This one broke, and so far we're down, 0.5%. Okay, and that little blurb up there at the end, I'm looking at many others. I have multiple monitors with different charts streaming, and that one's not, I think that's a little false print here on NQ. So we're down there, right down there. We close the futures shut down from 5 to 6 p.m. every day, and that's where I think we close right at the bottom. All right, so we'll see where that picks up. But again, by the projections, we're only half to at least a third of the way there. And I gave you also, again, take it, don't take it. That's the main thing. My goodness, I throw out dozens of trade ideas, over a dozen every month, individual stocks, and you almost never hear about those, and all you hear about is the market. And the market indexes are one of many, many things out there, and either take it or trade it. But if you trade it, NQ or QQQ, trade as a single position, like a single stock, like wheat or corn or crude oil. It's not something to put your entire portfolio into. And this is that 5-minute chart I showed you the other day. We had the divergent high, and we got we did have correction 1, as I showed you earlier today. I gave you another board, I forget where it was, and showed you, usually these divergences, quite often you have a series, divergent high 1, 2, and the divergences grow, and then the bigger correction sets in. That wasn't on this board. It was the one I posted a chart for you earlier today. And you can see there's that comparable uptrend line. This mirrors the uptrend line that I had on NQ. So that's broken, and that's that. That is a short-term sell signal. It is not a trend or a swing trade. A trend trade or a swing signal. It can morph into that. I'm going to show you a few other charts here. Move away from, these are price charts. So I'm right now analyzing price charts. The one thing before I move into the breadth indicators, so somebody asked me about the Dow today. Let me just answer that now. And said, hey, the Dow within a couple percentage points of the highs, new highs, all-time highs. So here's where we closed today, and we are currently down. Or let me tell you how much we have to get up. We'd have to rally about 5.52. Couple things to that. Number one, the Dow, you don't see me cover it much. It is the least representative index. It's only 30 companies, at least in the NASDAQ 100, although I would say Dow is, believe it or not, more diversified, more representative of the U.S. economy than the NASDAQ 100, because the NASDAQ 100 is over half tech stocks and has a super overweighting towards the big fangs. So at least in the Dow, you have other companies. You have banks and financials that you don't have in the NASDAQ 100. But with that being said, that's where it's at. And it's almost moot. You make a new high or not, that doesn't mean if you make all-time highs, then the market's going to explode. Quite often, individual stocks and markets top on equal or marginal new highs, and that's what we had here. Everyone was a little incremental marginal new high, and then one was the top. So we'll see how the technicals look at that time. Getting at or near, it makes headlines, and it will undoubtedly suck in some more retail traders, armchair investors that read the paper or listen to the evening news and might think, oh, Dow at a new all-time high. And I'll tell you my thoughts then. I already told you ahead of time, if we get up there and make new all-time highs, I'm going to have more and more of my my long-term trend indicators flip from bearish to bullish. But as of now, I think a decent case. Obviously, I said this last month when we closed out the month of June, and I had one of my long-term trend indicators flip, the 20-month period monthly exponential moving average, closing the S&P above that. I said, look, that does reduce the odds. It was a bear market rally, but doesn't eliminate them. And I still have over 50% odds, as I'm giving it this bear market rally. And we'll just look at fibs for fun. Let's go here to Fibonacci retracements. I think I had it on the daily. Let's see here. Oh, okay. What I did, I needed to populate it with the S&P 500. So this is one of my boards. I call it my fib board. I have different Fibonacci retracements. I'll walk you through this real quick. So here's the all-time high. This is when the S&P 500 peaked right in the beginning of January 2022. This purple line right here measures from the high all the way down to the lows. Just the low is right here, but that's where I took it down to. And so you can see the purple lines show you right now we are currently right on the 78.6. I often talk about how a typical counter trend move, meaning in a downtrend or bear market or a correction, a counter trend move is a rally against the trend, and obviously in an uptrend, a counter trend move is a pullback. So, and this is typically, I always say, where they go from about the 38.50 up to the 61.8. But there's a Fibonacci. I don't make these numbers up. These are all part of the Fibonacci sequence or the ratios. And 78.6 is a key one as well. And that's where we're at right now. And so if you look back here on the first real big bear market rally we had, from the highs down to the March lows right there, I put in orange. It's this orange line right here. This, I don't know if you can see it in the video. I use a black background. I kind of lose my fib lines. I can see them and I'm pointing it out to you. We reversed right under, a hair shy of the 78.6. So again, these are, sure, it's more of an extreme counter trend bounce, but it didn't, didn't certainly eliminate the fact we were in a downtrend when the 50, I don't have the 50 up there, the 61.8 or the 50 were taken out. I just want to tell you that's what that retracement was. That's what this one has been of the whole bull market. So you kind of try to, in my head, I always box my analysis into different time frames. And I know that's confusing to some because 1 minute I'm talking about the monthly charts and long term. I'm looking out years. And then the next minute I'm on these 5-minute and 15-minute charts. Now I'm looking out minutes to maybe days. But this is bigger picture. So it tells me that, hey, this is certainly stretching, getting up there on the limits, but it could still be a counter trend rally. But again, we need to reverse soon. And I said it when I did the video at the beginning of this month, we'll need to see the markets turn down soon to keep some of the long-term indicators bearish on the longest term, my monthly time frames, and any that flipped, or at least the one that flipped last month, to throw that back down and have it be a whipsaw signal. I showed you prior how accurate those trend indicators have been in the past, although it is pretty common to see a whipsaw for about a month, usually maybe 1 month on the monthly trend indicator. So that's where we're at. If and when a lot of these things start to get taken out, you take out the highs, you start to take out the divergences. These are all big things, and they're all things that have still been in place now for the last few months as I've been looking for. I probably never kind of had to direct everyone back to a call as I have so much in the past, going long a lot of the market and a lot of the market leading stocks right in the beginning of the year, and getting the first part of this rally, but then looking for, certainly getting out too early in hindsight. I'm stuck to my trading plan and looking for a turn. But as of now, this is still my next bear market target. I have a confluence of Fibonacci retracement levels, at least on this board. If that's confusing too, I have different, this board is solely fibs. And there's a confluence of key Fibonacci retracements of the longer term bull markets. There's one off the 2020 lows, and I have a longer term one off the March 2009 lows. That is really the bear market we're in. I still consider this pretty much a correction so far. I think we're looking at a much bigger bear market, and I know technically it'll go down in the books as a bear market with that antiquated 20% rule, which I for years said is ridiculous, especially in this era of easy money and massive manipulation from the central banks. It's just created bigger rallies, bigger bull markets, and then bigger corrections. And ultimately, it's going to create a much larger bear market than any have seen in decades. And so this is the next target down here. And if that's hit, that's going to be a drop of about 30%. And that's just the next target there. Okay, we're going to look at breadth indicators now, a few that I have from a different charting program. But before I leave this one, I wanted to, here's something I did today. I took a look at the equal weighted S&P 500, which is RSP. They have an ETF that tracks the equal weighted RSP, and of course the S&P 500. I've talked about this many times, and I know others have. This has been an unprecedented. This year has seen unprecedented, never before seen since we go back to the NASDAQ and the NASDAQ 100, the equal weighted indexes. Never before seen outperformance of the big market leading FANG stocks. Never did they have such a large weighting in the market, and never have they outperformed. So what you're seeing is it is, if you trade QQQ, that's what it is. If you trade QQQE, the equal weighted, well, then that's what that is. In other words, you get those returns, long or short. However, it is not indicative of the stock. It's not representative of the stock market. You want to look at the stock market, use indexes like the Wilshire 5000. Normally the S&P 500, but with this unusual outperformance of those big, they call them now the Fabulous Seven or some silly name that they've given to it. And it makes sense. I've told you years. I've started morphing away from the old FANG term. It's now you have Nvidia in there and Meta. So it's really the top 6 or 7 stocks that are doing almost all the returns this year, especially in the NASDAQ 100. But here's what I've done for you, and you can replicate this. So I compared RSP, the equal weighted, to kind of check out, see is this rally? Because remember, something I've said all along, I pointed that out early in the rally earlier this year, and I know others have, I'm sure. And I also said it would be healthy to see, the rest of the market start to participate. That would help to support the case that this is a early stage in a new bull market, with a bear market being over, and we're going to new highs and well beyond. Not a marginal new high, but 10, 20, 30% or more. That's where the consensus, from what I can gather right now, thinks we're going to do. Go on, blast through new highs, and ultimately go a lot higher. Okay, so here's the returns, and I use the bottoms in the S&P. So you're going to notice right here, 313, but then RSP bottomed a little bit later, but this is when the S&P. So to do an apples to apple comparison, I need to look at when the S&P bottomed, and what I did is measured the returns from the lows to the highs. So you can see RSP, the initial, here, let me just do it. There's the numbers. You can stop, pause it, and let's look at SPY, because what I did is I carried those returns over here. So in white, you have the returns on the S&P, and in yellow, the comparable returns over the exact same time period on RSP, the equal weighted. And so what I noticed off the October lows, it was a very healthy rally. That's what you want to see. 20% return in the equal weighted, 18% in the regular weighted. And if you recall, this is when I got bullish and long and stated clearly I expected outperformance in the NASDAQ 100, and mainly in those top handful of the big market leading tech stocks, and then named Apple, Tesla, and Amazon as my 3 top picks. And you can see that those guys, remember, even though the S&P bottomed here, when you look at Apple, see, it didn't bottom until then. That's when we nailed the bottom there, Tesla. And so that I want to just say that was a different dynamic. These guys continued to fall, Tesla, and then what I just say, Amazon. So that's when all the big tech stocks bottomed, and that's when we bottomed. So not there. That was too early. The October low was way too early for Amazon. You would have lost another, 24%, and also was short down to that bottom. Told you clearly, it closed all my index shorts, and these guys were all, and that were for many reasons, not just the positive divergence, but that was a big one. The bullish divergence that we had at the time at that low, that was a big divergent low, and all these guys, just like we come full circle now, and we have these big positive divergences. So the day that I stopped doing, because again, I'm saying this because I see the comments, and it's almost outright anger, like a mob out there. Why haven't we been long and bullish? And the big fangs are up year to date. They're up, blah blah blah. Again, we caught that initial run, and then admittedly didn't catch it all, and that's fine. You're not going to always milk a trade. It's one thing to catch a bottom on a stock. Very, very few can do it. It's what I have always done. I try to catch tops and bottoms. Sometimes you get cut trying to catch a falling knife, but that's what stops are for. And sometimes you get cut if trying to catch a top. And again, that's what stops are for. So I just wanted to point out, let's loop back to the breadth thing. And I wanted to kind of point that out to you again, how this is where everything that's being talked about today bottomed right there. So that first leg up was healthy because you had the RSP slightly outperforming, or at least keeping up. That's what you want to see, and it was outperforming by a little bit the S&P 500. That next leg up again was healthy, 13% lift in the RSP in the equal weighted, and 11 in the S&P 500. But since then, we've started to see a slip again, where you've seen the last leg up from March 13th to this peak right here. S&P went up, S&P 500 9%, equal weighted only up 7. Not huge, but again, what I look at, these aren't, you just try to recognize a trend in developments, and I'm pointing out that the equal weighted has been lagging. So from this leg up, 13% in the S&P 500 and only 10 in RSP. Oh, okay. And as I'm doing that, it hit me. I should include one more number. Okay, so this is where we've started to see again breadth deterioration. That's the definition of it. That is market internals deteriorating. It's nothing major, but it is something worth noting. And now let me do this. So from this low, because this is really where the equal weighted started to underperform the S&P 500, which again is not a good sign. That is a 19.43% rally, so almost 20% right there from the March 13th low in S&P 500. And the equal weighted over that same period of time, again, I got to grab that candle on March 13th, only 12%. So it's a pretty big difference there. And you can see, the equal weighted, if we put on the fibs, there we are right there. The equal weighted S&P 500 is still, so far we made a 78.6% retracement, but we're even below that peak back there. So this is what I'm trying to show you, is that as the market rips again, it is, and I've been through these market cycles. I remember this clearly at the end of the 2007 bull market, leading into the October highs. It was fewer and fewer stocks doing the big lifting, and it was back then what they called the FANGs, F-A-A-N-G, Netflix, Facebook, Apple, and Alphabet. So it is an unhealthy sign. It's no guarantee that the market must crater, but it is a sign of non-confirmation. Okay. We've only 27 minutes into this. I'm going to go over a few more charts and we'll wrap it up. So the other ones I wanted to talk to you about, breadth indicators. I have a lot of them, but some of the most reliable, and I'm really focusing right now on the NASDAQ 100 because that's where this stark and unprecedented divergence has been. That it shows nowhere better than the NASDAQ because of the overweighting here. Now what we're looking at here on the bottom is the NASDAQ composite. I didn't run the NDX. It would actually be more stark, and I should. I'll probably do that after this video. These charts are a little clunky. They take a while to annotate and load up. It's stockcharts.com. NAADW. So that's the NASDAQ Advanced Declining Issue Weekly. So it's the number of issues declining versus advancing. It's an indicator that I've used many times over the years to try to identify, problems in the market, the poor internals. This was the dot-com bubble. The NASDAQ fell almost 80% back then. And you can see clear, stark divergence heading into it, right? In other words, the number of stocks advancing versus declining was falling. So it's exactly what I'm telling you is going on now. And that proceeded, and it takes, and those conditions can build for a while, guys. Just like divergences just like overbought conditions, they are not timing indicators, they are conditions. And those conditions can build, get bigger, bigger, bigger. Once in a while, they just won't play out for anything or anything more than usually a correction in time. But most often, they play out for a major trend change, and that's what you had. So these are the last real bear markets. And then what you want to see, here's what I want to point out. When a bear market or a big correction is over, what you want to see and what you normally see is a immediate improvement in market internals. So here you can see I have a green arrow. The advanced decline line was going up, as was the stock market. This is not in log scaling down here, so it doesn't look like much, but that's a good rally. This was the whole bull market from the end of the 2002 end of that bear market to the highs. So in the beginning, especially early stage bull market, you're rallying, and the number of stocks advancing is exceeding the number declining. Then, as a bull market matures, and it takes a while, that trend starts to reverse and finally manifest in the form of a bear market. And that doesn't look like much right here. That's the 55% drop in the NASDAQ 100 and the S&P 500 back in the last true, what I consider last real bear market, October of 07 to March of 09. And again, clearly marked by breadth deterioration with a sharp drop off right at the top. You can see that it really started dropping off. Okay. Right in the beginning, bear market ended in March of 09. You had a sharp and clear improvement in market internals, and the market was going up. Then you started to diverge for a while, and you had some trouble here in the markets. A couple of years, 2 big corrections. Nothing much, didn't mark the end of it, but it was certainly stalled the rally there. Then leading up to the 2015 highs, this was the biggest. This was a sideways market. We went for a year and a half nowhere, and we had 2 big double-digit corrections there in 2015 and 16, and they were marked by breadth deterioration leading up to that. But guess what, guys? Out of the gate, strong. The internals up here, strong, improving. And this line's not very clear, but you can even see here was a big correction, a big drop, fourth quarter of 18. Right out of the gate, strong improvement in internals. COVID hit, 36% drop in the S&P, was a little less than the NASDAQ, but right after, strong advancing versus declining issues up there, right? All the way up to this point here. Then, as I pointed out on this chart at the time, if you were following the site, we started to see clear deterioration in market internals leading right up to the top when the market peaked back in beginning of 2022. And that gave us this correction called a bear market if you want. Okay, that was then. This is now. Let me just drop this down to a little bit. Let's go down here. Well, I'll show you in the video. I was going to zoom in. These charts are, like I said, they're just not very fluid to work with. But what I wanted to show you is right here. Hopefully you can see that in the video. So we did see, as I just pointed out a minute ago, looking at the equal weighted S&P, when the market bottomed back here in October, that was technically the bottom of the market back in October. Remember, the fangs kept falling until January. But in October of 2022, the market bottomed, and you did see for a while a little concurrent lift. The internals, the NAAD was going up in line with the stock market. We had a correction. That's fine. It's fine if they're moving together. Then you had another lift up, and I told you again that the internals were good. But from this point, this confirms what I just showed you with the RSP and SPY. Right here, this line, we had a peak. You can see this is where the NASDAQ has exploded. Look at that. Exploded upwards, and all along, the internals have not kept up. In fact, they deteriorated from that point. They've moved down. Remember, we're looking at a 20-something year chart. In the last few weeks, we have seen an uptick. So this is a trend to monitor, and this is a trade that we've been in, or at least that I've said a couple weeks ago, because there's so long that I don't see anybody saying, "Oh, Randy, I'm up 55% in Siri. Thank you," from when you pointed it out on March 26. But those are the trades. That's where on March 26th is when I started the videos, and some time since. Go for the lower tier stuff. That has the better risk rewards and the better charts. I wouldn't randomly select those stocks if the charts look like death. Most were trading at 52-week lows, but they had, guess what? positive divergences. Guess what? Those positive divergences have played out, and they played out on the majority of these stocks, mentioned back then. There's Siri with its divergent low, again, positive divergence. So these things quite often play out. And again, this one's up, since the breakout, 50 something percent, and a lot of others as well. I'm not going to go over each and every one right now. Just saying that what I'm trying to tie in is I am seeing just very recently a little bit of a spike, a little bit of a lift up. Nothing in line with what it should be. Nothing even remotely close to what you saw after these last big corrections and bear markets were over. But if this starts to go up, and I do see the lower tier and the mid tier, it's really the bottom 90% of stocks start to participate in the rally, even if the FANGs, the market leaders, stall out in the other 80-90% move up, or most of them, then you know what? This gives me a check mark for the bullish case and a big X, saying that we may go to new highs and beyond, and it makes it harder to support the case that this is a bear market rally that's could end at any moment now. As of now, this is pretty clear. Chart speak, and I got one or two more, and then we'll wrap it up here. Okay, this is also the end. This is the NAAD on a daily. So I was just showing you the weekly. This is a little closer up. And as my notes say here, I created this a long time ago. Said I early on I learned that it was best used as a topping indicator because positive divergence is not very common at market bottoms. So I use this mainly as a topping indicator. If it was a good bottom indicator, great. But what we do know is there was a last real bear market, 07 to 09, 56% drop in the NASDAQ composite. And right out of the gates, the internals improved along with the stock market rallying, right? And along the way, you had these divergences, and they were followed by corrections. Divergence between the composite up top, the NASDAQ composite going up, market internals going down, or at least in the NASDAQ, the number of advancing versus declining issues. And you got a drop, 20% drop, 20%, 30%. So you can see, and then the high right there, that's where we were short, and that's one of the many reasons why, not just short for pullback trade, but for a swing trade that, and that drop exceeded 23%. This must have been the last time I updated it. So there we dropped to that point. But you can see here, I put this line right here because we had a concurrent lift in both the NASDAQ and the internals right there, the NAAD. So that was what you wanted to see, and that was a good sign at the time. However, since then, since this dashed line, which is right around the beginning of the year, right when the FANGs bottom and took off, you can see a clear divergence with the NASDAQ shooting up, again, mainly because of just 7 stocks doing almost all of that heavy lifting, and the NAAD clearly going down over that period of time since the beginning of the year. So had we seen a continuation of this trend, I would be more bullish longer term right now, and much more open to the case. Not that I'm not open to it, but more leaning to the case that this is not a bear market rally, that this is a start of a new uptrend that's going to take the markets to new highs and well beyond. Okay, last one, because these things do matter. A lot of technicians, put a big weighting on internals. Okay, I shared this one with you within the last week or so, and it's one I'm watching, and it's done a great job. I know in a video you really can't make it out well, but I've talked about, because these lines are just so close together, and I just can't, I don't know of a way, I don't believe there's a way to separate them on this platform, but I have the NAHL. That's a little bit different. This is the NASDAQ stocks that are making new highs versus those that are making new lows. And basically, when the NAHL is above its 20-period exponential moving average, that's the red line, the trend is bullish, and you want to be long. It's had a great track record. As I said, and many times in the past, including last week, nothing's perfect. There are some whipsaws every now and then, some brief crossovers, but you can see it. That red line, it crossed there right in. Remember that the NASDAQ technically peaked in November, just before the S&P peaked in January, in the beginning of January. And so it gave you a sell signal there, and it kept on it this whole time until right now. We've had one whipsaw there after the October lows. So yeah, I'm sorry, distraction there. We had one little brief whipsaw right there. This histogram tells you when they cross. Now we're just ever so slightly crossed. This is a zoom in here. And so if this holds, then that's going to be something else, especially if we start to get away from it. Again, these little whipsaws are usually pretty brief. There's quite a few. But if we start to build, and this again, this is a measure of market internals. If this continues to improve and we see this one go up, again, it's another check mark that this rally may have some legs, because we are now seeing improvement in the market internals. But I can all but promise you, there's no guarantees in this game of trading and investing, so I try not to use the promise word, but I can all but promise you this ride, the almost single-handedly lift the market's getting from just 7 big tech stocks, not only won't continue, but the longer that divergence does continue, the greater chance it's going to lead to some type of crash type situation, because it's showing you the economy, the stock market is forward looking. And if most stocks, 90% of stocks, are going down or not going up, and you have a few going up, giving the indexes a false guise of strength, then that's sooner than later, when it becomes apparent to all, there's going to be a mean reversion. And that's the end of the day. There's always mean reversions in these type of things when you see these disparities one way or another. And that mean reversion is going to come in one of two ways. It's either going to be big fangs, or whatever you call them, big 7 tech stocks down, and the rest of the market up. That's one way to have a mean reversion. Or maybe the big tech stocks trade sideways and the rest of the market catches up. Or you go, the big fangs go down, and they probably go down even more than the rest of the market if the rest of the market takes another leg down, or maybe the rest of the market holds up. So anywho, that's what I'm watching right now. And again, it's just overall, the takeaway is it's unhealthy to see this type of negative breadth internal, especially as I showed you early in the video. It's more pronounced now in the last couple of months than it was earlier in the year. Okay, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.